Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you are enjoying this show and get some great value for your investing goals, let us hear about it with some honest feedback. We'd love to get a rating and review. It helps us, but it also helps other listeners find the show for their own investing goals. We've got a great show today. We're going to be talking to Brian Alfaro. Hey, on today's show of Multifamily Insights, we sit down with Brian Alfaro from Headway Capital to talk about the art of mastering that first investor call. Whether you're a passive investor looking to deploy funds or you're an active capital raiser looking to raise money for your next deal, you know that asking the right questions during that first investor call could make the difference in someone deciding to move forward with that partnership. Brian gets into some of the best questions you can ask and some of the questions he wishes people would ask him more about. And if you want to learn more, be sure to check out this conversation on Multifamily Insights. Let's welcome to the show, Brian Alfaro.
John, I appreciate you having me on. I've been listening to the show for years, and I don't know how you and I haven't connected in the past, but I'm better late than never. I'm excited to be here.
Hey, man, I'm excited to have you on. I appreciate you being an avid listener of the show. Listen, I went over your bio at a very, very high level. Take 2 minutes and fill in some of those gaps.
Yeah, for sure. For anyone who doesn't know who I am, so Brian Alfaro, Director of Investor Relations at a firm here in Houston called Headway Capital Investments. But kind of high level, I like to tell people my background because I think the thing that I find common when I talk to real estate investors is most people weren't in real estate prior to. So I don't have a real estate background. I don't have a real estate family, none of that stuff. I got into real estate back in 2017, fixing and flipping houses, buying rentals, following the BRRRR strategy, listening to Bigger Pockets, listening to shows like this one, absorbing as much education as I can. And then I took that education and I put it to work. Did that for a couple of years and realized like, holy crap, the single family space is not for me. Which I'm not going to say it's a bad investment, but it just didn't match my personality and my goals at the time. So turned 2020 right before COVID, got into a multifamily mentorship program. Big fan of just coaching and mentorship where possible. And learned the X's and O's of how to buy a good deal, how to raise capital for it, and then, of course, the asset management side of things. And I was off to the races. So started raising capital. That's really where I learned to plant my flag. And anyone who's here listening and maybe trying to transition from small single family to multifamily, or from small multifamily to large multifamily and raising capital. I didn't know anything about raising capital. I never raised $1 of capital beforehand, but I just took that same philosophy that I did getting into real estate and I applied it to the capital raising side. So I started learning how to talk to investors, how to find investors, how to coach investors through investment opportunities, how to set the right expectations so they don't have false hopes going in. And then sort of having that, sales mentality about follow up and nurturing your investors. And I was off to the races. And here I am today. So I've been at Headway for a couple of years now. I was working with some great partners before that, but decided this was the best place for me going forward in 2020, into 22, early 23. And now I take care of all of our existing investors, always talking to our prospective investors. I talk to our capital partners, like, fund managers and co-GPs that come in and partner with us on deals. And it's never a dull moment.
Brian, I love it, man. You got some great experience. You talked about a few things, right? Most importantly, you do not have a real estate background, right? 2017, you started doing smaller deals using a BRRRR strategy, realized single family wasn't for you. We're going to come back to that point. From there, you got some coaching. And I think that's really important. One of the first insights, we always talk about success leaving clues. For you, you realized real estate worked, but you didn't really like what you were doing in the single family space. You hired a coach and got some mentoring that allowed you to scale into multifamily. And ultimately now you're focused on investor relations, raising capital, working with investors and helping them invest into some of the Headway Capital deals. A portfolio valued over $500 million right now in assets under management. So obviously you've had some great success in that world. Take us back to that time, though. You mentioned around 2020 or so is when you went into the space to get coaching, but you realized the single family game wasn't for you. What wasn't right about single family investing?
That's a good question. So I like to joke that it's a whole lot of work and there weren't enough zeros at the end of the checks. So that was the thing, right? It's like always trying to value my time, and if I'm going to spend an hour doing X and it pays this, and if I could spend an hour doing Y but it pays more, single family and multifamily investing is just as hard as single family investing, and I saw the competition level in single family as well. The barrier to entry is extremely low, and that's whether you see that as a bad thing or a good thing. it meant there were a lot of unsophisticated people in the space. A lot of people, again, we all start from zero. I started from zero, right? Like I have a blue collar family. My mom's a stay at home mom, always has been, a single income family. Like I come from nothing pretty much as well. So I didn't get anything handed to me. I had to go to school, pay for my own college. And I was looking at my time and trying to value the dollars in my bank account and how I can maximize them in the single family space. I just noticed that there weren't a lot of people in that space that really aligned with my personality. I wanted to be talking to really smart people. Not that there's dumb people, and I'm not trying to blast the space, but I found that there were just a lot of people who watched a YouTube video overnight, and now they're knocking on doors and they're wholesaling, and they have no idea what they're doing, right? And it's kind of muddying the waters for the people that actually did know what they were doing. And then I also noticed that the market was getting really saturated, which was pushing down rents. The amount of work you would do, and you would buy a house, negotiate with a wholesaler, or get it on a contract yourself, put your own money in, or use hard money. You do all this construction, you take all the risk involved with doing construction, pulling permits, and all this stuff, and then you refinance out of that hard money or private money loan, and you're in fixed rate debt now, which is great. And you set some money aside for capex, for the house, knowing it's going to have turns and things like that, and issues. And it's like I did all that work, and I make $200 a month. So in my head, I'm like, my goal was to make $10,000 a month in real estate income. I'm not going to call it passive, because real estate is anything but passive, unless you are a truly passive investor, right? And I was doing the math. I was like, 10,000 divided by 200. I need to buy a whole lot of houses. And I just didn't want to go down that rabbit hole of owning whatever that math is, 50 houses or something. It was a large number. So in my head, it just made more sense. Well, why don't I buy a 50 unit versus buying 50 houses? It's harder, of course. The barrier to entry is much higher, but I found that the people were more sophisticated, and I like that nature. I like things that are harder, because harder means that there's likely more reward at the end of the line. So that was sort of my mentality on why I went that way. And again, I still think single family can be a very powerful vehicle for long-term wealth building. Buying a house now, letting a tenant pay it off in 30 years, and then you own it free and clear. That could be really powerful, and you don't need that many. Maybe you have like 8 to 10, but the problem is along the way, you're really not truly cash flowing, in my opinion. Even if you're making $200 or $300 a month, let's say a resident stays there for 2 years, you make $300 a month. What is that? $3,600 a year. That's $7,200 in profit. That resident leaves, well, you're going to spend that $7,200 painting, redoing the flooring, doing the AC every few years, all the capex, like sort of surprises that come up when you have a resident. So you're not really cash flowing, and you have to get to a really big scale on the single family side before you're generating income that can actually stick in your pocket. So that was sort of my discovery moment. And that's when I decided, if I'm going to take some risks and go all into something, I'm 35 now, but this was, I guess, 5 years ago. I was just turning 30. I was like, well, now's the time to do it. I don't really, if it all goes bad, I didn't have any kids yet. Now I have a beautiful daughter. I could just hit the reset button, go back to corporate America, and, try again another day, right? Versus waiting till you're 45, 50 and going, I should have did that 20 years ago. Let's take those risks now. So that's why I went into multifamily.
Great insights, great insights on your journey. What stood out to me was you mentioned it's a lot of work. And whether you're doing one house or 100 units, it's all a lot of work, a lot of steps in the process to get done. The challenge is you got to look at the other side. How much payoff do you get for all that work? And I think what happens sometimes in single family, you talked about, hey, even if you're cash flowing $200 a month on a unit, you might go 2-3 years with the resident paying, but if that tenant leaves, well, now you've got to go in there and spend money to renovate that unit, and you may wipe out the profits you made over the last 3 years in those renovations. People aren't factoring in capex, and a lot of times people are not, simply accounting for their time. So, when you think about the money, that's one thing. But if you're the laborer and you're doing a lot of this work, you're not necessarily factoring that into your return. So it could be a lot of work for very little return when you think about it, holistically, versus when you have scale, like in larger multifamily. Well, in that case, you can do the work. You have people, there's enough revenue generated to hire professional property managers, who are on site, third party companies, even just vendors. You can hire a professional plumbers who are licensed and bonded, right? And not
Yep.
just some dude who, fixes up some stuff on the side, which,
Sure.
when you're flipping a house, you got to figure
Every
out
dollar
ways to save
counts.
money, right? Every dollar
Yep.
counts. You wouldn't dare hire someone like that on a larger commercial deal, right?
Right.
So all those things kind of matter. I think, you talked about that sophistication of the people you are encountering. And I think that's part of what you're getting at as well, right? It's people who can
Yep.
help you grow and scale and think bigger and ultimately build a bigger, war chest for what you want to do moving forward. Let's
Yeah,
talk
John.
about
And
that.
there's one thing I
Yeah,
want to
please.
highlight too on that, and this is the last thing I'll kind of say about this. The thing I noticed between single family investors and multifamily investors, and I'm not throwing an umbrella and saying everyone in general, and you probably would agree with this, is in the single family space, I noticed that there was more of a scarcity mentality between investors. There wasn't a lot of help and sharing being involved. And then as soon as I got into the multifamily space, the first thing I noticed was like there's such an abundance mindset here. The pie is big enough for everyone to go around. And these are large multi-million dollar deals that it's very unlikely that most people are doing them on their own. So everyone realizes that, and everyone in the space is looking to help each other versus in the single family space, there's so little profit actually left at the end of most deals that everyone wants to keep everything close to the chest. They don't want to tell you who their subs are who offer a great pricing. They don't want to tell you where their best wholesaler is. They don't want to, because they want to keep all that to themselves. There's more of a scarcity mentality, and to me, I just prefer working with people that are looking to help each other out and have an abundance mindset.
No, I think it's a really good point too. And it's also important when we talk about real estate to be careful who you listen to, because that mindset and that viewpoint obviously informs the way people think. So really good
Right.
points there. Let's talk about what you do now. You focus primarily on investor relations. Uh, some folks understand exactly what that is. Some folks have no clue what those words mean in that order. So describe to us what investor relations is and what you do with Headway Capital.
Yeah, that's a good point. A lot of people don't know. I've never thought about it that way, but it's true. If you would ask me 5 years ago what that meant, I would have told you I have no idea. Essentially, what I do is I build relationships with people so that they feel comfortable and confident investing with us as a passive partner in our multifamily real estate projects. The thing that really makes it challenging for some people getting into raising capital or investor relations is a very slow burn. It can happen, but it's not common that you see me on Facebook, John. You go to my website, you fill out all your information, you immediately schedule a call, and 7 days later, you're wiring me $100,000. It can happen. I've had that happen. It's not as common. What's more common is you somehow fall into the funnel. You somehow get nurtured, whether it's through my social media content, you hear me on a podcast, you see me on YouTube, you have a phone call with me, and then you watch what we do for 6 months, 3 months, 12 months. And then you finally invest when you realize, like, okay, I'm not a fly by night. I'm not just a guy who's kind of here one moment, there another. We're a legit company. We've been around for a while, and we're going to continue to be around no matter what. So the nurturing process is really what I spend a lot of time on, is building strong relationships with people, getting my foot in the door, getting them. There's several subject matter experts in the space that talk about you want investors to know you, to like you, and to trust you. Well, they can't like you or trust you if they don't know you. So I spend time making sure people know who I am. Then once they know who I am, it's up to them to decide if they like me. But I try to be personable, connect with people, show them our value proposition and why we might be a good fit for them. And then I try to build trust along the way so that when we have an open investment opportunity, you and I already have some sort of substantial relationship where you at least are interested in potentially investing in one of our projects. So that's essentially what I do, is build relationships with people, get them to invest in our projects. And then once they actually invest, it's my job to make sure that they have a good experience. Constant communication about the project, monthly updates, phone calls if needed, webinar updates, just making sure that they know what's going on. Because as you know, John, it's a 5-year investment. Usually, not everything's great all 5 years. It's not all roses. There's going to be, hopefully not ugly, but there's going to be good, bad, and ugly things to communicate. Right? Things happen. These are projects, right? I mean, there could be fires or floods or occupancy issues if there's some issue, right? And it's delivering that communication in a timely way, making sure they understand we still have our 2 hands on the wheel. We're controlling the asset. We're heading in the right direction. We're just taking the high road to get there, right? So the communication is a big part of it as well. So that's essentially what I do at a high level.
Yeah, you talked about helping individuals who want to invest in real estate passively, helping them get comfortable with the idea, right? Building relationships with
Yeah,
them. You talked about know, like, and trust factor so they can get to know you. They decide whether or not they like you, but
right.
ultimately, help them get comfortable making that decision and educating them throughout that process. I want to talk about this a little bit more. First, from the LP or the passive investor's perspective, and then I want to come back and talk
Sure.
about it for those who are active and looking to raise capital themselves. For that passive investor, right? You have these conversations every day with folks. What's the most common question or objection you hear when you speak to a new potential investor?
That's a good question. I think it depends on their level of education. So the best calls are the ones where they've already made up their mind that they want to invest in multifamily. Now, sometimes I know where they caught the bug and sometimes I don't. Sometimes they listened to your show and somehow they found me on LinkedIn, right? Or they listened to somebody else's podcast, or they read a book, or their brother's cousin's uncle has had a lot of success in syndications and now they want to do it too, right? You just never quite know. So I always try to ask that question, like, hey, how'd you learn about real estate? How'd you find out about us? What got you interested in it? Sometimes you just never quite know where they find out about it. So those are the easy calls, and those easier, I should say. And those I don't usually get a lot of objections because they've already made up their mind that they are interested in passive investing. They're interested in multifamily. They like the asset class. They're just more doing due diligence on our company, and they're doing due diligence on me and our partners, and just making sure that we're the right fit, because not every firm is the right fit for the investor. And it doesn't mean it's a bad firm, and it doesn't mean it's a bad investor. It's just sometimes there's just a personality thing. You might not like my personality, right? And that's okay. It doesn't hurt my feelings. Plenty of investors out there, and you might talk to somebody else who you have a more just a better conversation with. You vibe with them a little bit more, and that's cool too. Invest with who you feel better investing with. So those questions are more like a get to know you. You already made up your mind. You want to invest in real estate passively. You don't have the time to be a single family investor. You like multifamily. Let me tell you about our company, our track record. Let me point out some of the risks involved, of course. So I get questions about that. What are the average returns? What are the risks involved? Kind of just good questions you should be asking if it's your first time investing. Have you ever lost any capital? Capital calls. Just adjusting both the good, the bad, and the ugly, which is what I try to do. From a sales standpoint, I don't want to make it sound like there's absolutely zero risk involved. There's zero chance you lose your money and everything's going to be rosy. That would be very misleading. So I try to be really realistic with the expectations and what could and should or couldn't happen with anybody who's savvy in real estate. Now, if somebody has no idea what we're doing, and they've never heard of this, sort of syndication model and partnering with others, they steer their conversation a little bit differently to make sure, well, first of all, there's a saying that a confused mind says no. So I try to not make what we do sound really confusing. If I use words like syndication or IRR, or just get too technical about things, you're often going to confuse people about what's going on here, and it opens up even more questions that gets them even more confused. So I try to keep things really simple about, hey, look, we pull investors together, we all put our money together, and we go out and we buy big projects, and we all benefit along the way. Here's how we benefit as the sponsor, and here's how you benefit. Here's who does all the work, and here's what you do. Here are your responsibilities, to keep it really, really simple. So for those objections that sometimes I get, or maybe from people that are or more savvy investors in a variety of different alternative assets. So people that, for example, have invested in the past few years in like a lot of treasuries and different things where treasuries are really strong. The last few years we've had like crazy CDs, 4.5%, 5% CDs. And they have questions about, well, why would I give you my money for 7% cash on cash when I can put it in a treasury and get 4% risk free? Well, that's a good question. Let's talk through the difference between a treasury and alternative investment like yours. Let's talk about the tax benefits. Let's talk about the equity upside, and let's talk about the risk. And then you can make the decision if that's a good fit for you or not. I'm not trying to, tell you one's better than the other. You can make that decision. So it's more of an educational conversation. So those are common objections that I get from people. But honestly, it's most people I talk to, and that's what I love about the space. I don't get a ton of objections. I get really smart questions because most of the people I talk to are really smart. They're either towards the end of the career and approaching retirement. They're looking to diversify, or they're kind of mid-career, 40s, 50s, and up. They're making good money. They have $50,000 to $100,000 to invest. But they just want to understand the risks that are involved and the upside as well. The number one question that everyone's thinking about is, if I give you X dollars, how much money am I going to make? So we can talk about that, of course. So yeah, those are kind of generically speaking, most of the common questions that I get.
I love it because you hit on a couple things I was going to get into, but to recap some of what you said there, most of the time when you're getting these calls, those are what we call like warm prospects, right?
Yep.
They've gotten to know you. They are reaching out to talk to you because they've seen some of your content or they've been following you or they've, heard about other people in your deals, right? So they're coming to you with the intention of potentially investing, right? So they've got questions. They're trying to learn more about the process. So
Yep.
it's not like a complete grill session where they're just asking you a million questions to test your knowledge, right? They're just trying to learn if this is right for them. So a lot
Yep.
of it is getting to know each other. Some of those questions you talked about, your background as a sponsor, track record on deals, understanding deal structure, returns, communications, have you ever lost money, things
Yep.
like that, right? So just really starting to learn who you are, how you operate, some great questions that investors typically ask. What's a question that you very rarely or never get asked that you think more people should be asking you? Not you specifically, but just the operators.
That's a good question. I don't think enough investors focus enough on the risk, to be quite frank. I think a lot of people get on genuinely pretty excited about the opportunity. They've seen or heard, again, they've been nurtured, which means whether it's me or somebody else is doing a decent enough job making sure that they understand, like, hey, there's some actual, like, really awesome upside here. But what they often don't ask enough questions about, in my opinion, is what are the risks involved either in this model, if we're not talking about a particular deal. Now, if we're on a call and there's a live deal and we're raising money for, 123 Main Street, tell me about the risks involved with this particular deal. What's worst case? What's base case? What's best case? Because you want to make sure that the pro forma and sort of that return expectations that are being provided in that particular offering are not best case. You ideally you want them to be somewhere between worst case and base case. I think asking about the risks is really important. What are the risks here that can involve? Also asking, have you ever lost investor money? I don't get asked that enough, to be quite frank. Probably, I don't know, I have to make up a number, less than half for sure, probably like 20, maybe 30%. People ask me, like, hey, have you ever lost investor capital before? Asking about capital calls as well. Have you ever had a capital call? And if you have, why? Being able to speak to it. A lot of operators have over the years done capital calls. And to me, I'm a passive investor too, by the way. So I invest in other people's projects, including our own. And I ask these questions, and it's not always what they say, but sometimes it's how they say it. Right? Can they answer the question confidently? And do they have a learning experience? Because the thing I've learned being in this real estate for 8 years now, and multifamily for 5, is if you're planning on doing this business for the rest of your career, 30, 40, 50 years, and you do 2 or 3 deals a year, I mean, do the math on that. You're going to do 100 plus deals over your lifetime. They're not going to all be slam dunks. They're not going to all be home runs. There's going to be some bad apples in there where maybe you break even, maybe you lose some money, hopefully not. But if you have a 95 out of 100, that's a pretty good track record in my opinion. But you're going to have 5 bad apples in there, right? So 5 groups of investors aren't going to be happy. 5 deals are not going to go well, and whether that's your fault or the market, it is what it is. So what I want to look for is, can they confidently speak to that? Can they confidently say, like, hey, we had a deal, 5 years ago. We projected a 18% IRR, and it ended up being a 10% IRR. Here's what happened. Was it the market? Was it you? Are they taking ownership of it? What happened, and how do you got to make sure that that doesn't happen again? So I want to get asked those types of questions about capital calls and different things. So risk, just generally risk questions in general. Everyone loves talking about the upside. I mean, that's the sexiest part of real estate, right? But nobody wants to think about what could go wrong. And I think that's an important thing to highlight, because these are investments, and there are I always tell people, there are 0 guarantees. I make you 0 guarantees. Anything you see on a spreadsheet, on a PDF I sent you, they're projections, and it could all go to 0. Has that ever happened? No. But could it? Absolutely.
Brian, I love what you just said, and I really hope our listeners take those words to heart. And I agree wholeheartedly. The questions we don't hear enough are about risk. And I
Yep.
always find myself having to inject my own risk questions
Yep.
so that, again, they have a fair assessment of the opportunity. Because I know you mentioned that, this kind of sales as well. The one kind of balance or downside is we always have to be careful as those folks who raise capital that we aren't convincing someone to invest. You
Mhm.
want this to be their decision. They have to be
Sure.
informed. They have to understand the risk. They have to truly understand the risk. And our jobs are to really make sure that they understand those risks and they're comfortable, and not to just sell them the sexy upside and
Yep.
look at all this upside potential and get people super excited. Because if you do have deals that don't pan out, you want to make sure that everyone's fully aware of the risk. And yes, it may throw some cold water on the flames a little bit there. But
Yep.
the truth is we want people excited about the opportunity while still acknowledging the risk. One thing that I will just add to what you mentioned, when you're asking about someone's track record and deals that didn't perform, capital calls, things like that, I always like to listen for accountability
Hmm.
in that answer. Do they acknowledge what they could have done differently? Have they incorporated and learned from that mistake or those challenges and made adjustments to their process? And ultimately, you're going to have, or none of us are perfect, right? Like you're not going to go 1,000 on every single deal you do, but you want to learn from those mistakes. You want to learn from those challenges. The thing that's a huge red flag for me is hearing someone blame just other people,
Yep.
circumstances, and not taking any ownership. And I've had contractors steal money from me before, right?
Sure.
I had a GC, I paid for some roofing work, and apparently he didn't pay the sub. And the sub called me, threatened to put a lien. I'm like, what are you talking about? I paid the GC last week.
Yep.
And that's when we found out the GC pocketed our money and ran off, and we had to, do other stuff. Listen, it sucked for me. I lost $25,000 right there, right? Lesson for me was, you know what? We got to make sure we get, these releases from the subs before we pay the contractors. Like that's part of the process now. It sucks that it happened, but we also learned a lesson that improved our process. So those are the kind of things that I'm listening for, just to make sure we're learning and getting better as investors. Because part of the reason you invest as a passive investor is because you want to ride our coattails on mistakes we've already made.
Yep. Yep.
Let us make those early on mistakes. And now you can really ride that experience for your own investing success. Doesn't mean we're perfect, but obviously, it's better than someone who's doing this for the first time by themselves for sure.
Absolutely.
Yeah. Let's flip sides, right? We talked about it from the LP side. Now I want to talk about it from the GP side. We have some listeners who are looking to raise capital for the first time. We know that there's opportunities in the marketplace. What's one of the biggest mistakes you see new investors make or new operators making when they're getting on the phone for the first time with a potential investor?
Oh, that's a great question. I think two things to highlight. I think one is a lot of new capital raisers take the process too transactionally without realizing. And you had mentioned that I mentioned, and we were chatting before the show, that this is a very sales, in my opinion, it's a sales-like position in the sense that yes, you are. You had used the word, had said earlier, the phrase like being careful about not convincing someone, and I 100% agree with that. But I also will say that the sales part of it, where I think it's important to highlight, is that what I mean by sales is that you have to get really good at painting a picture and telling the story of what the investment is and the upside opportunity and why we like this deal and all that. And that's the sales part of it. And the second part is also building the relationship, which we spent quite a few minutes talking about a couple minutes ago. And I see that all the time where, I mean, you probably get them too, John, on Facebook and on LinkedIn. I'll get cold messages from people. I have no idea who they are. And they say, hey, Brian, I see you're in real estate. It looks like you're an accredited investor. I've got this great investment opportunity. Click this link to see the investment offering. Here's the link to the webinar. And I'm like, I have no idea who you are. This could be the best deal in the world in the last 30 years. I have zero interest in investing in it. And I'm not clicking anything you send me because I have no idea who you are. Right. And a lot of people, they go through that transactional process of not building a relationship with people first. And when they start their outbound outreach, because there's some, again, back to sales, there's some prospecting involved in being in this position, meaning you have to go out and find investors. If I, just like on the internet, if you were in person and I walk up to you at a happy hour or a party, John, or we're hanging out at some, business networking event, and I walk up to you, John, and I'm like, hey, John, my name's Brian. I'm a real estate investor. Do you want to invest in my deals? Like, you'd think I'm crazy. I didn't introduce myself. I didn't say hi. We didn't make any small talk. What do you do? What do I do? Do you have any kids? The thing you would normally do at like a cocktail party, right? When you're out networking and mingling, socializing, right? And it's for some reason, like on social media, people forget that social media is about being social. So same thing. Don't, send somebody a cold message and be completely transactional. I mean, I get it, right? LinkedIn, especially, it's a very somewhat transactional environment. There's a lot of sales going on there. And again, I get it. B2B stuff, especially, but don't confuse B2B to B2C. And this is B2C. We're selling to customers, and people have feelings and emotions and thoughts and opinions, right? So I think that's one. And the second thing I would say is, you had asked specifically about when they get on the phone. I think the number one thing that I've heard and see, when I've listened to like some other people that are, newer in the space, and and I'm pretty sure I did it too, was they get too focused on the numbers, right? So like, you get on a call, and you fill out a form on my website, John. You tell me you're interested in passive investing, and I get on the call, and all I'm talking about is, well, John, this, what we do is we provide 20% returns, and all our deals have this IRR and cash on cash and da da da. I'm talking too much about the numbers without finding out, why are you here? Why is John here? Why did he schedule this call? What are his goals? Right? Tell me about your real estate investing experience. Why are you looking to invest in real estate? Are you looking for passive income? Are you looking for equity upside? Are you looking for tax benefits? What's your motivation to actually get on the call with me? Because if I don't understand your problem, I can't present a solution, right? And real estate has a lot of solutions. It has a cash flow solution, quarterly, monthly distributions. It has a equity upside a solution. Put your money in, I'll double it for you. And it has a tax benefit solution. Give me 100 grand and I'll give you, 40, 50, $60,000 in bonus depreciation. If I don't know what your problem is while we're going through that discovery process on the phone call, I can't present our opportunities and our offering in the light that best fits what you're looking for, right? So I might be talking about cash flow, and you might make $1 million a year. My 7% average cash on cash means absolutely nothing to you. 100 grand and you get 7 grand, you probably spend that on your mortgage payment every month. It means nothing, right? But maybe you have a tax problem, right? Maybe you're looking for tax losses. You need losses every year so you don't get killed by Uncle Sam. Well, if I find that out early, I can spend more time talking about taxes than I would about cash flow. You probably could care less about the cash flow, right? I've even had investors say, hey, can you just keep the cash flow and not give it to me until the end when the whole thing sells? I just need the K1. Awesome. I'm not going to do that, but it's an interesting statement, right? That tells you what type of problem they have. They have a tax problem and a cash flow problem. So I think those are the two big things: being too transactional, and then not doing enough due diligence to figure out what the person's actually problem is, spending too much time talking about the potential numbers versus figuring out why they're even here.
Brian, that's a master class in how to get better at investor relations, right? One, you don't want to focus on being transactional. Again, that cocktail party or the networking event example is perfect, right? You would never just walk up to someone and start pitching them event or
Yep.
pitching them your deal. Yet we see it all the time on social media, and I get it too. I get those emails, I get the Facebook messages, the LinkedIn messages, and it always drives me crazy. Like, does this work for people? So you don't want to take that approach, right? You definitely want to make sure you're focusing on the relationships and getting to know people. When you get someone on the call, so many people focus on the numbers, and I would go a little bit further and say, so many people lock in on themselves, right? And they feel like they've got to sell you on themselves and the deal, and that's all they're focused on. And they're not taking the time to listen to that prospect. What are
Mhm.
you looking for? What challenges or objections or issues are you trying to address? And then how can this deal help you? And that's ultimately what we're trying to do, right? When we talk about being in the sales environment, all sales is trying to figure out what the buyer's problem is
Yep.
and whether or not your product or service can help them with it. And if it can't, you move on very
Yep.
quickly. But if it can, maybe you didn't highlight the right features, right? So, if you're buying a TV and someone just needs it to do XYZ, but you're over there talking about, how the HP is super high definition and it's got all these cables. Look, dude, I just need a TV that
Yep.
works. And there's a great example. I forgot who told me this, but there's a guy who went up to a salesman who wanted to buy a TV. He asked this guy, can tell me, how's this TV? And the guy starts going off all the features, right? And he's naming out all the things, and he's like, okay, he's just more confused now. He
Yep.
asked the next guy, hey, can you tell me about this TV? Oh, it's a great TV. Well, how's the picture? Beautiful. All right, cool. I'll take it.
Yep. Yep.
Right?
Yep.
Super simple.
Yep.
Like, I didn't ask you all this technical stuff, man. I just need to know, is this a good choice? And when it comes to investing, again, same thing, right? Like, people ask the questions that they care about. You definitely
Yep.
want to make sure that they understand the investment. So I certainly want to take time to coach and educate people on that. But on the same note, you don't need to tell them every single thing there is to know about everything that's in the deck, everything that's in every other
Yep.
page. answer the questions that they have and focus on them. So I love that, Brian. For folks that want to learn more and connect with you and your team, they can check out headwayinvestment.com. We'll put a link to that in our show notes. And you're pretty active on LinkedIn, so we'll put a link to your LinkedIn page in the show notes as well, so folks can connect there. Brian, right now we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the Mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
Oh, good one. I have a good one. So my very first single family investment, I actually put non-refundable earnest money down, $5,000. Wasn't as bad as your $25,000 loss. It was my very first deal. I found a deal through a wholesaler, did all the underwriting, thought it checked all the boxes that you should be, but I backed out because I got cold feet. Okay. I ended up losing my earnest money. Obviously, it's non-refundable, $5,000. Felt terrible, of course. Nobody I had to go tell my wife, like, hey, we just did our first real estate deal. I lost $5,000. And secondly, I ended up watching that deal. Somebody else bought it. I saw it hit the MLS. I knew what the wholesale price was. And then I knew what the renovation was, because I even had a sub come out there and quote it and do the whole thing, right? And I saw what it sold for. And I missed out on over $40,000 on a flip because I was scared on my first deal and essentially got cold feet. So one thing I always tell both passive and active investors is there's no such thing as a perfect deal. And eventually you have to take a leap of faith. If you've done your education and you've done your due diligence, you can always talk yourself out of a deal. But eventually you gotta put all that education and stuff to work. So that was a big learning experience for me. And I'm not going to say I do every deal I see, of course not. But it definitely reminded me that there's a saying, I heard this at a casino one time: scared money don't make money. So it's like, eventually you got to take some risks.
Love it. Give me a digital or mobile resource you recommend for our listeners.
Ooh, digital or mobile resource. Digital resource. That's a good one. I mean, honestly, I think there's a lot of great people. If you're in either an LP or a GP or co-GP or whatever your business model is, and you're not staying on top of what's going on LinkedIn, I think that community has just really exploded in the last couple of years, maybe 3 years in particular. I've been active on LinkedIn for a little bit more than that, when it was not as appealing. But LinkedIn there's some really smart people on there to follow. I mean, definitely make sure they're following you, John. Make sure they're following the podcast. There's just so many valuable resources out there. So I would say the best thing is be on LinkedIn. And second best digital thing is to make sure they're following this show.
Love it. Appreciate that. Give me the book you've recommended or gifted the most in the last year.
Ooh, good question. So one of the favorite books I have is The 7 Habits of Highly Effective People by Stephen Covey. It's not a real estate book, but I'm a big mindset guy. I like to make sure I sharpen my pencil so I read that book every year. I gift it to people. It's a book that definitely hits at different stages of your life. So sometimes I'll go a year. Sometimes I've skipped a year where I don't read it for a couple of years, and then I reread it and I'm like, man, I interpret it so much differently as I age. So that's a great book. I definitely recommend it if you want to be somebody who focuses on forming good habits.
What's a daily habit that helps you stay focused on your goals?
I would say definitely working out, although I do have a newborn at home, so I've fallen off the radars there, rightfully so, but I'm starting to get better. The last couple of days, I've actually gotten to go to the gym 2 days in a row, so it's a huge step in the right direction for me. But I think whatever it is for you, finding it, whether it's working out, going for a walk, doing something like that, where you can kind of hit the reset button, decompress. I'm not at the gym like on my phone. It's just like my zen. It's just being there, working out, clearing my mind, working my body out. That's my safe space.
Give me your number one insight for being effective at investor relations.
Good listening. I think we mentioned that. Too many people are listening with the intent to reply. Like, okay, when I'm going to ask this question, and when they're done, I'm just going to go here, right? It's like, listen to what people are actually saying. So that you can understand how to best solve their problem, or how you can tell them like, hey, this isn't a good fit for you. So be a good listener.
I love it. Let's go in a different direction. So you are in Houston. Give us your favorite place to grab a bite to eat.
Oh man, you can't do that to me. There's so much good food in Houston. Houston is a phenomenal food scene. I'm a big fan of Asian food. So my wife is actually Vietnamese. We eat a lot of really great Asian cuisine. I would say one of my favorite Sichuan restaurants in Houston. They've got multiple locations now, but it's the original one is called Mala. Mala. It's a Sichuan restaurant. There's one on Bel Air. There's one in Sugar Land. There's one in Katy. They're all over the place. But if you like spicy Chinese food, it is awesome.
All right. Sounds like a great option. Brian, really enjoyed our conversation today. A couple of things jumped out to me. Listening to kind of your journey into real estate, starting out in single family. Appreciate you sharing that story about doing your first wholesale deal, backing out, losing $5,000, but using that to say, okay, you got to just be confident in the work and the preparation that you put in, right? From
Yep.
there, you start doing some single family, eventually transition into multifamily, and now you focus on investor relations as a part of the Headway Capital team, and really just understanding what it means on both sides. As an LP investor, asking solid questions, what you should be looking for in that vetting process. And then if you're looking to raise capital, making sure that you are listening, listening to the questions, answering the questions the right way, but also focused on solving the problem of that investor. Really, really good insights, and appreciate you sharing that with us today. Again, for folks that want to learn more, they can go to headwayinvestment.com, and you can check out Brian on his LinkedIn page, which we will put in the show notes below. Thanks again, Brian, for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.